Hey, evening, everyone. Thank you for joining us tonight on this webinar itself. So tonight we have an interesting topic here is that navigating through the storms using facts and myth. If you're the kind of person that likes a lot of facts and figures, I think tonight will be something that you will enjoy a lot. A very, very thorough research has been done by the team, Stella, Geethard, and also from the luxury team itself. There's a lot of interesting angle whereby we'll explore certain things. I will take a lot of questions and answers towards the end, but feel free in the middle of this webinar itself, if you have any questions, put it inside the question and answers box itself so that our panelists can address them one by one. And then definitely I'll pick up some of the most important ones and then just share it with everyone else publicly. So without much further ado, I'm just going to ask Stella to come into the center stage and then just project her screen. Hi, evening, Stella. How are you tonight?
Hello, everyone. Good evening. Hi. Welcome to the webinar.
Thank you, Stella. It's a hard day for you because you've been doing this since morning. In the morning, you've done a briefing to all our staff and our people. And then at the evening itself, you're going to do it a second time. So I think you have mentioned that you have prepared a long and hard for tonight. In fact, she's prepared for a month. Her webinar is supposed to run last month, but due to certain reasons, we reschedule it to further later back. But we are glad that it happened. Okay, Stella, I'm going to hand it over to you.
Okay, I'm going to start my screen sharing first. Okay, can you
Stella, I
see
think
the
I can see your screen clearly, but may I feedback that maybe in your voice, if you can adjust a little bit louder, it might be good. Because on my end, I'm hearing a bit soft. I'm not sure about the rest of the participants.
Okay, let me see what I can do. Is this better?
Yes, it's better now. I think it's good.
Okay, all right.
Thank you. Okay. Over to you, Stella. Have a good evening.
Thank you, Eddie. Well, this topic is not going to be easy to cover. There are so many angles because I'm covering market dynamics. A lot of people has been asking me, about investments, about the current situation, how the market will go from now. So the thing is, I have a lot of data, but I'm going to try to keep it as simple as possible. You may see some slides with a lot of charts and all that. Don't worry about all the nitty-gritty details of the charts. I will explain the charts in a very simple manner so that you can understand easily, okay? So just a little bit of introduction about myself. I've been with PropNex since 2010, graduated from NUS with majors in econs and statistics. And I was previously a senior equity sales director in a major stockbroking firm for about 10 years or so. So I've been with PropNex since day one. And it has been a very wonderful journey for me with PropNex, I must say. Love this company a lot. Okay, so currently I'm the chief IC of 6 large projects, and the rest of the large projects that you see over here, all these projects I am involved in them as a developers representative to discuss about to present the project to clients. So disclaimer, it is not meant to be any investment advice. This is just a presentation of information sharing. So just make sure, and also do take note that there's strictly no recording during the seminar or photo taking. Thank you very much. Okay, let's get started. Now, before we get started, we have to think, what should we do? How should we plan ahead? First and foremost, I think that whatever decisions that we intend to take going forward, we need to gather good quality data, not just any data, but the highest quality data possible. And we have, with the data that we have on our hands, then we have to examine the range of possibilities that we can go for, whether which options are we taking, what possible paths are we taking. And for each of these paths, we need to weigh the risk versus the rewards according to the choices that we will make. And after that, we will be, with all this, weighing the risks and rewards, we'll be able to make clear decisions. So my presentation outline for today, searching for the silver lining in the midst of a storm. So that will be the first segment. That will be on market dynamics. Second segment will be on the Singapore property market, the facts and figures rather than the myths. And the third segment, I will discuss with you about identifying a good class CCR project that can outperform the test of time, that can outperform the rest. Okay, so as we navigate through the storm, there are a lot of facts, a lot of myths in the market, and so what is really true? So the information I'm going to share with you have been gathered from very major research papers from the major big banks and so on, and fund managers as well. So is it a bear trap? The market has recovered, the stock market has recovered somewhat from the low in the market. The thing is it a bear trap or a new bull rally? We're going to discuss about the US stimulus package. Is it working? Scenarios for the economic impact of COVID-19 crisis. And of course, Singapore property market, how will we fare? Is there a probability of a market crash? And why do most people hold back from buying right now? Because maybe they are thinking that there are distressed developers out there, or there are distressed owners. And if the interest rate is less than 1%, how do we stay ahead of the curve? So what is a bear market rally, and what is a new bull? A bear market is a market that trends downwards. That means the market is going down. A bull market is a upward trending market. That means prices are increasing. So in a bull market prices will keep on rallying, right? There may be corrections, but you'll go up again. However, in a bear market, usually the rallies may be shorter, but the drops will be even more. Okay, so this recent recovery here in the US stock market, this recovery, is it a trap of the bear market, or that means is it going to come back down, or is it going to continue to go up? If it continues to go up, it is a new bull. But if it comes off, it means it is a bear market trap. Okay. So if you look at this research paper, at the bottom here is you can see the source, SG Cross Asset Equity Quant. This is SocGen, okay, SocGen paper. Quant funds are very, very big funds. They trade based on, they sieve through a lot of data to cut out all the noises. They sieve all this in order to source out the momentum, all the relevant data that they will need in order to do trades, and their trades are usually very, very big trades. So you can see from this chart over here that the red one is the current pandemic of 2020. So you can see that the market recovered so fast, right? It was a severe V-shaped recovery. But the point in question is this recovery sustainable? From the 150-year history, it shows that in order for the market to recover back to this level, it needs a time frame of maybe about a year or so. But recently, the recovery in the stock market was a matter of weeks, not a matter of 1 year. So the key thing is to ask ourselves, is this sustainable? And then usually, if we look at this performance here, the red box here, okay, the red box here, these are the bear market rallies. The green box are the blue market. This is a new bull. Okay, so these three segments here will represent the three big drops, the three crashes in the market in the last 20 years or so, last 20, 30 years. So in 1987, there was a big stock market crash, Black Friday, if you all remember. And there was a small rally about 1.5 to 2 years later in 1989. But did it really go on to become a new bull? No, it came back down, and the new bull started only in 1990. So you can see that this is one pair here. Okay, the second pair is a result of the second market crash. That was in the year that was a dot-com crash around the year 2000, and there was a small rally, but the rally was only for a short while and came back down, and then it rallied again in 2003. So it was about 3 years later before the market really started a new bull trend. And the third crash was the recent Lehman crisis, where the prices dropped, the prices went up again. That was the bear market rally. Then it dropped a little bit, and then it started a new trend here. Okay, back in 2009. So that was maybe about 6 months later before the market started a new bull trend. So you can see over here that in the bear market rally, all these classifications are categories of different kinds of stocks, okay, by fund managers. So what kind of stocks recovered during the bear market rally? They were led by these segments here, okay? So you have the growth stocks, the neglect stocks, the momentum stocks, the growth stocks here, value stocks, and low price stocks. What are low price stocks? Low price stocks are the stocks that have dropped the most in terms of prices. So, but then you can see that in the bear market rally, they don't really have a common factor. But in a new bull market, the common factor is low price. Low price. Okay, for all the three new bull market, it is low price. This research was done by BOA. Also, BOA is also a quantum fund. So these two are very, very respected research papers. And you can see that right now in this current pandemic, it is not led by a low price stock. It is led by value and risk stocks. Okay. Okay. So the thing is, if you see the crash here, then you ask and the recovery, who is not buying? Who is not buying into the market? If you see the green line and the blue line here, these are discretionary and systematic strategies. What are they? They are actually purchases by institutions. Okay, the first one is essentially algorithm trades, machine trades. Very little human intervention. But the second one is discretionary trade, is human trading, positions placed by fund managers. So you can see that the algorithm trades has gone down substantially. This shows that the big funds are not really buying. Okay, they are reducing the equity exposure. Who else not buying? You see all these categories here, all the different kinds of funds. The funds are not buying. Can you see that? Okay? The funds are not buying. So you see the green line here. The green line is the US stock market index, S&P index. As the market index goes up, you can see this is the uptrend here, right? They recovered from mid-March. Mid-March was the bottom of the market, then it recovered. But you can see the blue line. Blue line is the US fund flow, equity fund flows. That means investors are withdrawing money from the funds. They are withdrawing money from the market. So there is this gap over here, right? And so if the institutions are not buying, machine trading is flat, hedge funds are bearish, then who is buying in the market? You can see over here, after the lockdown in February, the trades has gone up, okay? Robinhood.com is actually a retail online portal. So this tracks very closely open positions by retail buying. So retail buying has gone up a lot. Other than retail buying, who else are the ones buying? Apple bought back their shops. I mean their shares. So Apple. So you have some company buybacks. Apple bought back their shares. Retail investors are putting their money in the stock market. And if we examine, see, this is the title here. The stimulus package, is it working? This shows that what I'm trying to illustrate here is that the diminishing impact of quantitative easing. What is QE? What is quantitative easing? It means the government is printing money. They print money to inject into the market. So they have to manage it carefully, right? So when for QE1, they pump in $200 billion worth of funds. But the corresponding increase in the money supply, M1 money supply, the corresponding increase is 95.6. So I must say that QE1 worked very, very well back then in March in November 2008 until March 2010. Then they had a second round, QE2. QE2 started in 2 years later, 2010. This time round, they pumped in $550 billion. And the efficacy is the corresponding increase in money supply is 73%. However, so you can see that from 95%, it has dropped to 73%. Then they started a third round, QE3. So QE3, they pump in even more money, $1.6 trillion. And this time round, the efficacy is only 28%. So you can see that the corresponding increase in money supply has dropped. That means it is less and less impactful on the market. That's why it's diminishing impact. So now, in this current situation, we have QE4. QE4, they pump in so much money. Can you see here? $2.4 trillion worth of funds. And corresponding increase in money supply is 32%. Okay, so pumping a lot of money, efficacy is only 32%. So it seems like there is a shortfall of $3.3 trillion. There is this shortfall. So because of this shortfall, it is widely expected that the US is likely to carry on with another round of QE. There will be most likely there will be a QE5. Okay, so next we discuss about the debts in the market, okay, and whether economies can service the huge debt in the market. The blue bars, what are the blue bars? You look at on the left here, national debts as a percentage of GDP. So this is the debt that the country has as a percentage of the GDP. If you see the yellow line is percentage of tax revenue collected to service the interest of the debts. That means the interest that you are paying out of the tax revenue that you have collected, in other words, okay? You can see that in 2020, the debt level has gone up. Debt as a percentage of GDP has gone up a lot. But did this spike up a lot? Did the yellow line spike up a lot? The interest that they have to serve, it didn't spike up a lot. Why is that so? Because the interest rate is now very, very low compared to the past. And you can see over here that there is this probability chart where they show that what is the probability of interest rate staying below 1% over the next 5-year period. In the US blue line, Euro area is red line. The probability of interest rate staying below 1% is anything from 70 to 90%. That means it's highly likely that interest will stay low for quite a while, over the next 5 years. So having discussed that, where do we go from here? Let's see how COVID-19 compares to past outbreaks. We have SARS started from China. The last case of SARS was in July 2003. Vaccine available back then the same month, okay? And then that was the last we hear of SARS. Number of countries affected, 29. Number of infections, 8,000 plus. Number of deaths, very low, 774 only. H1N1 from Mexico, last case was 2010. That is because the vaccine came in December 2009. Number of countries affected worldwide. 24% of the world population were affected. And the US itself, 60.8 million people. Number of related deaths, 284,000. That's a lot of people dying. Let's look at COVID-19. COVID-19, when will we get a new vaccine? Nobody knows. Probably, maybe they are saying that it could probably be in June 2021. Number of countries affected, 188. The number of infections, 4.9 million people as of today's numbers. And the number of related deaths, 323,000. This has already surpassed SARS, surpassed H1N1. So now the thing is, with COVID-19 ongoing still, we don't see an end to it so soon. Economists, this is, I think this is by McKinsey, if I'm not mistaken. So this report here, you can see this is a matrix. This matrix has two factors. One is public health, and the other factor is economic policy. So depending on public health response and economic policy, what kind of outcome will we get? Are we going to get the V-shape, U-shape, or even L-shape? The economists are predicting that most likely it will be this gray portion here. Okay, that means it can be a very smooth U curve. Okay, most likely it will be one of these four patterns over here. So just now, remember we discussed about two factors: public health and economic policy. So let's look at the response by government. In the USA, well, their lockdown is a bit half-hearted. Social distancing, also lack of coordination. You have people demonstrating over there in the US about being locked down and all that. In China, very strict enforcement and very good coordination. They locked down very, very early, just around Chinese New Year time. And then we have Singapore. Singapore, they try to do a balanced approach. As things evolve, they will respond accordingly. So in terms of economic policies, okay, you can see that USA, massive, okay, they pump in money, massive wholesale. For China, they started small first, sequential, and then they have these 6 policies. These 6 policies will go into employment. For those who are able to read Chinese, they are looking at employment, the structure of the basic needs of the people to minimize bankruptcies or decimation of businesses, and then food and energy, okay, and to keep the supply chain intact, and also the basic infrastructure of to keep the basic infrastructure running. Whereas in Singapore, wow, we have a massive package, $60 billion, right? And then all measures are sequential, meaning they will see what needs to be done and then they will implement accordingly. So which region will probably lead the way out of the COVID crisis? So again, public health and economic activities. If you look at public health, Asia is in yellow color. Started in Asia, after that it tapered off very quickly, number of cases. But you can see that Europe and the Americas is all rising very fast. After that, the curve is so steep. But as of May, they kind of the increase is slowing down. How about economic activities? The red line over here is China. You see, when China locked down, it was a sharp V curve, V shape. And then when they opened again, it recovered very fast. This is the economic activity. This is the manufacturing purchasing managers index. But the rest of the world, take note that this is only until March. Okay, we don't have the latest for April and May yet. So you can see that the US, they're all turning down. Look at Germany coming off as well. US has come off and is continuing to come off. Apparently the last couple of months, April and May, the numbers are going to continue to go down, whereas China has bounced back a lot. That's why they're all queue up to buy Hermes. Okay, and then we have Asia. In China, okay, what is this congestion index is the traffic congestion index. You can see that this is the norm, okay, recently it has already recovered. And for air, road, and rail, came off, came back up again. For the government bond indices in China, very steady, but the emerging markets is coming off. So which areas are best poised for recovery? We have Bank of England, the interest rate is at 0.1. European Central Bank, almost zero already. How about the US? Fed funds, zero, negative 0.25. This is the range right now. And then how about China? China, they use this 1 year medium-term loan facility rate as a gauge. And look at that. They have bullets. They have an arsenal of weapons to tackle the market. So China is very, very steady, I must say. And if you look at the China here, as the share of world GDP based on PPP. What is PPP? Purchasing power parity. Okay, so you can see that the share of the world GDP, the share of world GDP, China is increasing, and is increasing very fast. United States has been coming off. How about percentage of global industrial production? Again, China is a factory of the world. It is going up. US has been coming off. Then we look at the population. Just now we looked at what did we look at? We looked at the percentage of world GDP. We looked at the percentage of world industrial production. Then now we look at the population. In Asia, we have a large and young population, and that is very important. China will become an aging country only in 2030s. India is a very young nation. The population will start aging only in the 2050s, right? So you can see that over half of ASEAN is also young, over half of ASEAN are below 30 years of age, very young population. And if you look at the chart here on the right, rapidly growing consumer base in ASEAN. Who is growing rapidly? 2013, light blue color, dark blue is 2030. Who's growing rapidly? Indonesia, even Philippines, Vietnam, Thailand. So these countries, ASEAN as a whole, is growing at the rate of 101%. And also this is from McKinsey. Yeah? So you can see that we have a good consumer base. Not just good consumer base, we also have people, young people, manpower, employment, labor, right? So we have the labor and we have the consumer base. So that will be the basis on which an economy can grow. Oops, sorry, let me do my screen sharing again. Okay, sorry about that. Okay, so you look at the magazine by The Economist. It says bye-bye, goodbye globalization. Is it going to be hello regionalization? You have the two big giants pointing fingers at each other, okay? So we have a lot of issues between the two countries. They have, with the ongoing, the trade war, the tech war. So we want to see if globalization were to reduce and regionalization increases, what happens? Share of urban consumption growth between 2015 to 2030. What is the percentage here? You can see over here that United States and Western Europe will drive 32% of consumption. China and Asia will drive 49% of global consumption in the decade ahead. So usually who has a bigger consumption power will be the winner, isn't it? So China and India have been building domestic supply chains. In this chart, what you see is that the gross exports as a percentage of, as a share of gross output, it has been increasing because why? They have been building a very big domestic market. Their numbers when their export numbers are increasing. However, as a percentage of the domestic market, the exports are reducing because the domestic market is increasing by leaps and bounds. So you can see here that Asia, from 27% of annual trade value, increased to 29 to 35 in 2017. How about, this is global trade, okay? How about intra-regional trades? That means trades within a specific region. Asia Pacific itself, you look at that, more than 50% of trades are intra-regional. And our Minister Chan Chung Seng says that Singapore will be well poised for that purpose. Okay, so now we go on to the property market. How will we fare? That is the question on everybody's mind. How will the Singapore property market fare? There are 4 characteristics of a country that will affect the effectiveness of a fiscal stimulus. Number 1 is the level of development of the country. Number 2 is the exchange rate regime. Number 3 is whether they are very open to trade, their openness level to trade globally, and also public indebtedness. Let's take a look at the property price index. This is the price index from 1991 all the way to this quarter, last quarter, first quarter 2020. So this chart is just to show you what happened in the past. If we place the past crisis against the price chart. In 1997-98, can you see here? We have the Asian financial crisis. And after the Asian financial crisis, what kind of recovery did we have? V-shaped recovery. After that, we had the dot-com bubble debacle. And then we have a U-shaped recovery after that. You can see this is a U-shaped recovery. But in between, we had SARS happening for Singapore. SARS last case was in July 2003. Okay? So this was a period of SARS in Singapore. And then we have the global financial crisis, the Lehman crisis. Recovery very fast, also V-shaped recovery. In between, what did we have? We have the H1N1. Okay? H1N1 lasted for 1.5 years, but in Singapore, it was shorter. Okay? By Feb 2010, we are done with H1N1 already. So we are not really affected very much by H1N1. Neither was the V-shaped recovery. See this V-shaped recovery? It was not affected by H1N1 at all. And then what do we have now? Since this period here, since the start of 2011, 2010, 2011, this whole period here, you can see that this is a period of cooling measures. We had 8 cooling measures altogether. And these 8 cooling measures culminated to, at this point here, when we had the implementation of TDSR. Okay, so you can see that with the implementation of the TDSR, I will not go into the 4 whammies, but you can ask your agents about it. So with the TDSR, effectively, the government is curbing the ability to borrow. So because of that, the market came off. But as the market came off, subsequently, all the stock, all the inventory in the market was absorbed, they were sold. And then after a while, developers realized that, hey, they didn't really have enough land banking. They did not have enough land. So what happened was, after that, the market recovered and you have the en bloc fever craze starting. So what did the government do? In July 2018, the government implemented the cooling measures. And these cooling measures one of the cooling measures was on the developers to stop, essentially to stop the en bloc process. So we had a little bit of hiccup here, but after that, you see the market still continued to rise. So you can see over here that all the cooling measures were done here. What am I trying to show you here in this chart is that all the cooling measures were already implemented. All these cooling measures already did they deflated a potential property bubble. So is there a property bubble now? No, all the cooling measures here already took the wind out of the market. And this already happened when the rest of the world, because of QE2, QE3, the rest of the world were going up and we came off instead. So what will contribute to a high-risk market? Property bubble is one factor to consider. Is there a property bubble? I just showed you just now that the property bubble, there is unlikely to have a property bubble at all because all the cooling measures already took the wind out of the bubble. So there was no bubble in the first place. And then is there an oversupply, over leverage in the market? Are there a lot of speculative activities? And is there an economic crisis? So this risk here, plus a couple of conditions for people to be able to pick up fire sale units in the market, because we do get questions from clients whether is there a fire sale in the market. So fire sale in market, there must be two conditions. Number one, there is a sudden surge of distressed sellers. Number two, they must liquidate within a short period of time. These two factors will contribute to a fire sale in the market. And you can see over here, I'm going to explore four reasons, okay? For discussion topics here, whether we will have any fire sale in the market or not. Okay, so before TDSR was implemented, there wasn't any limit on the number of properties to finance. So if you have the funds, you can go and speculate, you can flip options. People could buy many properties. But after TDSR, income capped at 60% of income, interest rate at 3.5%. This is essentially the stress test by the government, by MES. That means even though the interest rate is now 1%, MES wants bankers to calculate the rate at 3.5% to see whether a person's, to check on the eligibility for the loan amount. So interest rate calculated at 3.5, although interest is only 1%. So after TDSR with the stress test, it reduces the risk of a sudden surge in distressed mortgages. That means people can withstand, even if interest rate were to go up to 2%, 2.5%, they can still withstand the increase in interest rates. But then that is not the case right now. Right now, the interest rates are on a low. The second topic I want to discuss is ABSD. Before ABSD was implemented, many people, especially multiple property owners, they can keep on buying and buying and buying. Okay, so after ABSD was implemented, foreigners, they have to pay extra 20%. Citizens, for the third property, they have to pay 15%. So a lot of people curb their investment in real estate because of this reason. So because of that, is there any speculative activity? There isn't, because this is anti-speculation. And for anti-speculation, let's discuss also point number 3, okay? And that is the seller stamp duty. So the first that we discussed was TDSR. Number 2, we discussed ABSD. Number 3, we discussed seller stamp duty. So for seller stamp duty, homeowners avoid selling in the first 3 years so that they do not have to pay the seller stamp duty. So because of that, you can see that the percentage of sales sold within 3 years, percentage of transactions is only 2.2%. Very, very low. And longer average holding period, 8 to 9 years. That means in the past, if you look at this chart here, in the past, in December 1999, number of years of holding a property was only two years. But right now, it averages 8 to 8.9 years. Okay, that means people are holding their property longer. They are not speculating. So point number 4, this one affects the developers. Okay, they affect the developers. So you can see that the ABSD applicable to all developers, 5% non-refundable, 25% remissible if all the units that they develop are sold within 5 years of the purchase of the land. Then you have the qualifying cert, applies to all developers with foreign shareholders. They must sell within 5 years when the TOP plus 2 years after TOP. Otherwise, they will have to pay the QC extension charges, okay, which is actually very, very hefty. So because of all this, developers can no longer hoard land. Okay, so because there is anti-hoarding, there is a calibration of supply in the market and pricing discipline, meaning developers have to price accordingly. They have to price to sell, okay, so that they will not be hit with the ABSD and the QC charges. And so because of all this, it will also affect land bid prices, especially with the implementation of the minimum average size, okay? Because if there is no minimum average size, developers can build a lot of shoebox units and sell at high PSF. If they can do a lot of small units and sell high PSF, they will be even more gung-ho to bid high prices for the land. So the government doesn't want land cost to have a runaway land cost, so they have to manage that, and so therefore they implemented the minimum average size of condos, especially in certain areas. Okay, then why is it that some people are still holding back their purchases? Maybe they feel that they can buy cheaper in future, or maybe they feel that they can buy cheaper because there are distressed developers in the market, or distressed owners, or they have worries about a distressed economy, or maybe they are worried about job security. So you can see that in the recent last year was the number of launches was quite high, but this year and next year you can see that the launches are coming off, tapering a lot. So there's a decluttering of new launches. And what I'm going to show you here is are the developers distressed even in this COVID period, lockdown 2 months or maybe 3 months, but they have an additional 6 months to sell. Okay, so the data I'm going to refer here is based on URA first quarter 2020 data. Okay, this is my Kueh Lapis. Okay, so this Kueh Lapis here, you can see that we have the units make from these 4, okay, 1, 2, 3, 4, these 4 add up total 46,000 units going to TOP between 2020 to 2023. Okay, these are the 4 years, the blue, the orange, gray, and yellow, 4 years period. Okay, it's going to TOP. And then we have an additional one. This one will TOP, 5139 units will TOP in 2024. Okay, so total 5,001 here. Add to this, we have about 51,000 units altogether. So let's look at the blue segment. Blue segment are those that are going to TOP this year in the year 2020. Of those that are going to TOP this year, 4,506 units, already 87% have been sold. That means only 500 units available for sale that are not sold yet that are going to TOP this year. Okay, for those that are going to TOP in next year, 2021, already you can see 56% sold. Meaning 6,000 plus sold, only 4,000 plus still unsold. How about the ones going to TOP in 2022? 2022, we have 34% already sold. And those that are going to TOP in 2023, 27% already sold. So you can see that these 4 years over here, the supply during this period is somewhat fixed because the construction period takes 3 to 4 years. You cannot say you want to supply next, you buy land this year, you want to have it the supply TOP next year. Not possible at all because the construction period is fixed for 3 to 4 years. So because of this, the supply for this period is fixed already. Then, so what is the supply? So as I mentioned, we take the statistics as of first quarter 2020. So what is the balance supply of units? 27,000. So it means that all these that are not yet sold, Okay, these 4, they are not yet sold. You add this up, 27,351 units. Then how much time do we have? Right now, because we take the statistics as of first quarter 2020, we minus off this first quarter, we have 3.5 years, 3 years, 3.75 years. So this number, 27,000, you divide by 3.75 years, you get 7,294 units to be sold per year, starting from second quarter up. For the next 3.5 years or so. Okay, so per year 7,000 plus units. But last year was not a very fantastic year because a lot of people felt that, wow, there were so many launches, so many choices, no hurry at all, right? So the number of units taken up last year was only 9,912, and I will explain to you why I say only, because normally it's a lot more than that. So last year was 9,009. But the units left to be sold 7,000 plus per year for the next 3.75 years. So you can see that this black line here is the average net new supply for this period. The average net new supply of 11,773 units over the 4-year period. So if the black line is the supply, then what is the take-up rate? The take-up rate between 2009 to 2018, in this 10-year period, the average take-up rate was 11,406. So you can see that usually the average supply is 11,000 plus. The take-up rate for the last this 10-year period was also about 11,000. But last year was lower. Last year was only 9,009. That's why I said last year was not a very good year actually. Okay. So then what is important is to look towards future. Okay? If the supply during this period is fixed, then what about the future? Beyond 2024. So beyond 2024, currently we have 5139 units already slated to TOP in 2024. Out of this 5139, 124 units have been sold already. So the balance is 5015. So moving forward, it all depends on whether this year there will be any more en bloc, or whether this year there will be any more GLS coming on stream. So you can see that 936 units are already under construction with prerequisites for sale, meaning they already obtained the sales license. And there are 4,000, out of these 5,000 over units, 5139 units, 936, they got the sales license. 4203, they are not even ready for sales yet. They don't even have a sales license yet. Okay, so there's ample time. And of course, going, as I mentioned just now, what is going beyond 2024, what is the supply situation like? The government is in control of the land supply in the market. So they use the government land sales as a stabilizer. So when they find that there is a lot of land supply in the market, they will hold back the government land sales. So in 2019, total GLS units, land sold with the number of units that will be constructed was 3735. In first half of 2020, so far is 1,175 units. So if you look at this chart here, total is only 5,000 plus, right? So this is the GLS land. How about en bloc? Because of the ABSD and so on, en bloc actually came to a virtual standstill already. You can see that after the 1718 period, the late 1819-20, hardly any en bloc. So will we have a lot of en bloc units coming on stream beyond 2024? Currently, it doesn't appear to be so at all. So total TOP in 2022, 10,822. TOP in 2024, 12,000. But from the en bloc supply to TOP in 2024, only 448 units. Very, very minimal. And usually en bloc will mean freehold projects. Okay, and then how about inventory in the market? Is the inventory declining? You can see here inventory is going down. That means unsold inventory is declining. Okay, so people have this overwhelming feeling oversupply, but no, inventory is already reducing. And so now let's look at let's look further and beyond. My question to you now is this: how many % of land do you think is being used for residential housing in Singapore? You know, whenever we ask people these questions, usually they will say, oh, maybe 30% of the land or 40%. Some people may even say, oh, 60% of the land is used for housing. Let's look at the numbers. In 2010, percentage of land used for housing was only 14%, only 1/4. And in 2010, we have a population of 5 million people. Others, 14%. Okay, defense requirements and all that. Now you cannot really take any land from defense for housing. Why? Because defense land over here is meant as a catchment area for our reservoirs, for our water. It's a catchment area. So this is the situation in 2010. Housing 14%, others also 14%. Then let's look at 2030, okay, in 10 years from now. When the population increase by 2030 because of the population white paper, it will go to minimally 6.5 million people or up to 6.9 million people, an increase of anything between 28% to 36% in the population. By then, housing will have increased from 14% to 17%, and under others from 14% reduced to 4%. After 2030, do we have a lot of land left? This is really land scarce Singapore. So next, let's look at the market, whether we have distressed owners in the market. Are the Singapore households, are they over leveraged? Are they, did they buy too many properties? They are over leveraged. They borrowed so much from the bank that they have to quickly sell. Or are they overexposed to property? Are property values, Singapore property overvalued? Private property prices affordable? That's the key question, okay? Are the prices affordable for Singapore households? Are rental use weakening? Are there enough households to take up the new launches? Okay, first let's look at whether Singaporean households are over leveraged. Red color, what's red color here? Growth of household liabilities. That means your borrowings. You can see that borrowings have gone down, whereas the yellow line is growth rate of assets. Okay, if you look at in 2010, assets $1.4 trillion, liabilities $200 billion. So this part here, the light blue here, this is the liability, and this bar here is the assets. So you can see the proportion of assets to liability. Then you look at 2019, stats up to last year. Assets increased by 65%. Okay, so assets increased by 65%. Liabilities up by 53%. So even though liabilities have gone up, but the growth of assets is much higher than the growth of liabilities. Again, let's look at another aspect to see whether households are over leveraged. The light blue is the debt, CPF gray color, and then cash. That means undeployed capital is black color. You can see that the Singapore households, as of fourth quarter 2019, cash and CPF made up, okay, how much is this? Almost 900 billion. Whereas their mortgages and their loans, the total debt is $324 billion. So for every $1 of debt, they have $3 of savings, or rather assets. Every $1 of debt, they have $3 of assets. Let's look at the mortgage payment versus income. During 96-97 period, okay, during this period, you can see that let's say every $100 that you earn, okay, because we're looking at mortgage payments versus income. Every $100 that you earn, you pay 78% as mortgage payment. Is that sustainable? I don't think so. That means you left only $22 to do all your other things. 78 goes towards payment for mortgage. So the market came off quite a fair bit. And in 07, 08 period, it was 45%. Even then, it was too high. But you look at the right now after TDSR in June 2013, the mortgage ratio to income is only 29%. That means out of every $100 you have, you only put in $29 for mortgage payment, and the bulk of it comes from where? CPF. Okay, don't talk about foreigners. Most of them, they don't borrow money anyway. Even if they do borrow, it's very, very little. So this light blue is for private property, and the dark blue is for HDB. HDB is even lower, 21%, because of mortgage servicing ratio of 30%, whereas private property is TDSR of 60%. Okay, but even then it's lesser than 60%, it's only 29% mortgage payment versus income. Then let's look at this. Okay, so you can see from this chart that whenever you have a level, let me put up a bit more. Okay, whenever you have a low level here, okay, low level here of maybe 35%, you see the bottom of a market. Similarly, over here, you see the bottom of a market. But when the mortgage to income ratio is higher than 40% or 45%, what do you see here? You see here, you have a peak in the market. Similarly, here, you see another peak in the market, right? Over here, you see another peak in the market, right? So the markets have to come off, and the mortgage mortgage to income ratio has to come down to be more sustainable. Okay, so far so good, everyone. I hope you are following me so far. So the ratio is artificially suppressed after a series of cooling measures since 2010. And therefore, because of these cooling measures and lower mortgage ratio compared to your income, there is a reduced risk of a sharp correction in the market. Owners are not distressed. Owners are not desperate. If anybody come to you now and ask you, would you like to sell your property for a 20% discount? Let's say your property valuation is $1 million. And they say, oh, market is bad. Give me a 20% discount, 800,000. You want to sell? I don't think so, right? Because most owners in Singapore, we are not distressed owners. We are steady, right? So if you look at the this next chart here, residential this is a diversification of wealth portfolio. Residential property as percentage of household net worth. That means of your net worth, okay, how much of your money goes into real estate. In 1995, the amount of money that goes into real estate was 68%. But by 2019, the amount of money that goes into real estate is only 49%. That means people have already been diversifying their portfolio, their wealth, their assets. They put into different asset classes. And for real estate, they have already reduced their holding from 68% in the past to 49%. I think mainly attributed to ABSD that they have to pay. So you can see 68% drop all the way down to 49%, okay? Now, this next chart shows you that the relative value of Singapore private property versus other countries. You look at New Zealand, how much has it gone up? How about Hong Kong? How about China? How about Malaysia? Malaysia boleh went up 182%. How about Singapore? Tak boleh lah, only 107%. So you can see Singapore real estate was really, really down in the doldrums, mainly because of several reasons. Over here, this period was the four whammies, oversupply, under demand, and all that. And then when that was done with, we have a series of cooling measures all the way. So that's why the Singapore market didn't really go up very much. It only went up a miserable 7% from 100 basis point, from 100 to 107. Okay, so let's look at the property price index versus GDP growth. So usually these two lines will tend to hug each other. But you see over here, you know, I call this the broomstick of the witch. The witch flew in. Okay, so when the witch flew in, what happened? There was diversification. The red color is GDP, and the blue color is the private property price index. In the past, it used to be together, but at this point here, where the black dotted line is, it has diversified. So GDP continued to grow, but the property price index came off instead. Minister Lawrence Wong always says, property prices must go up, supported by, if property prices were to go up, it must be supported by fundamentals. And what are fundamentals of the economy? GDP, household income, and so on, okay? So if we have strong fundamentals, GDP growth is good, but property price went the other way. Why? All because of TDSR. TDSR curbed the borrowing so much that a lot of people couldn't buy additional properties, or, you know, so because of that, we have a gap here of 31%, okay? This gap, 31% gap. Then let's look at the property price index growth versus income growth. Just now, what did we talk about earlier on? We talked about GDP growth, okay? So now we talk about income growth. So again, the broomstick appear with the witch. So you can see that this blue line here is the property price index again. And the red line here, this red line is the mean income of the population. You can see that there is a gap over here, right? But if you look over here, the mean income continued to go. However, the property price index has come off. In fact, after that, it came back up. In fact, if you see these two together, it means that people have the means to pay for the property. It should go hand in hand with each other. Okay, then let's examine who are the people who can afford to buy a private property. Let's look at the numbers. This number here, it shows the deciles. That means this is the average monthly household income from work among employed households. That means not business people, but salaried workers, okay? Salaried workers, 91st to 100 percentile, these are the top earning salaried workers. 60th percentile, 61st to 70, so these are the top 40%, this group here, okay? The top 40% of salaried people. So average monthly household income has gone up 51% or 4.22% per year since 2009 to 2019. So in this 10-year period, household income has gone up 51%. And then, of course, people, if you look at the number of people who are staying in HDB flats, is 78.6%. Then you look at people who are staying in private property. Private property, 291,000. But the people who can afford, the top 40%, who can afford a private property is actually more than 500,000 households. If more than 500,000 households can afford, only 291,000 are staying in private property now. There is a big pool of people of 200 over 1,000 people, 200 over 1,000 households that can afford private property. It's just that they are not buying yet. So, and income has also increased. All these are the corresponding deciles. So all the income has increased substantially as well. So let's examine the top 40%. Are they able to afford private property? So we have 548,000 households that can afford although 291,000 households, only 291,000 households are staying in private property. So these people, this 40% of people, you look at the income level, average household income, if their average household income is close to 14,000, they can afford to purchase a $2.48 million property based on 60% TDSR, 3.5% interest rate, 75% loan to value, and 30 years tenure. So a lot of people can afford in this 61st to 70th percentile, sorry. And then you have this lot here that can afford and up to almost 3 million. And then the top tier, they can afford up to $5.57 million of property price. And then you look at some people may say that, well, what's the use of buying investment property if it's going to stay vacant? So I can show you that the vacancy rate has dropped. That means more and more people, more and more units are being rented out so the vacancy rate has dropped quite a fair bit. You can see that the vacancy rate has dropped to only 5.4. Frictional is about 4%. Frictional meaning when a lease expires, another tenant may come in between, it may not be occupied. So that's what we call a frictional rate. So right now it's 5.5, very close to frictional rate already. And then if you look at the different segments in the property market, CCR vacancy rate 7.4%, RCR 6.2, overall 5.4, and the OCR 4.1. Why is OCR vacancy rate lower? Because most of the units in OCR are what? Owner occupied. So therefore it's not so many are for tenancy purposes. And whereas in CCR, more units there are for investment purposes, for rental. And if you look at the population white paper, as of 2019, we have a 5.7 million population. And if we were to hit 6.5 million people, okay, 6.5 million people, we take the lower rate, we don't take the 6.9. We hit 6.5 million people by 2030. That means 80,000 people a year, or 24,700 households per year will come into Singapore, based on 3.24 heads per household, according to the latest statistics. So if this is the case, we are expecting the take-up rate from foreigners to be 24,700 units per year. And over here, let's look at the people who are staying in condos. Yearly additional households, new additional households per year basis, you can see that these are all the additions. In 2019, additional 11,700 units are added to the market. That means more and more people are moving out of other types of property into maybe HDB upgraders. They move into condos and apartments. So additionally, every year, the take-up rate by these people, 11,700. So on the average for the last, from 2012 to 2019, average was 11,888. And all these people who move into the condos, 83%, they own the units. Who are staying in condos, 83% are owner occupied. Okay, so I won't go into this very much. It's just to show that more and more people are earning more than $14,000 per month. That means they cannot buy HDB, they have to go and buy private property. Additionally, every year you can see addition of 20,000, 14,000, 20,000 people who are earning more and more. That means they cannot qualify for HDB. So the number of people staying in condos and apartments is on an increasing trend. So you can see that the HDB up 1.59% per year between 2005 to 2019. Then you have condos and apartments up 5.85% per year between 2005 to last year, 5.85. Singaporeans are very good. They have high aspirations. They all want to upgrade as far as possible. And so let's look at the overall Singapore property market. Is there oversupply? Is there over leverage in the market? Is there overexposure? Or is there an overvaluation in the market? That means our prices so high that it becomes unaffordable. 40% of Singaporean households can afford private property, and there is no overhang of vacancy rate at all. Healthy demand for new launches. We have also examined temporary deferment of the mortgage payments because of COVID. This is the government's measure, deferment of mortgage payments if you choose to. And for the developers, they have a temporary easing of ABSD and QC remission by 6 months. So are there chances of a heavy sell-off in the market? Any desperate sellers in the market? Very, very low chance. So is our market at risk of crashing? I doubt so. I really, really doubt so. So if you are in the market for a condo, and if you are looking at a project that is of good class, that can withstand the test of time, that can outperform the rest, then let's look at the 10 attributes that a good class project should have. Okay, I will go then. With these attributes, you can do your checkbox. In fact, if your project can attain 10 out of 10, is fantastic. If the project that you have under consideration can hit 8 out of 10, I would say is already very good. Okay, so how many checks can your project achieve? I will be using Martin Modern and the Avenir in my example for illustration purposes. I'm not here to sell you the products because I don't have time to do that. I'm only using it as an illustration in my example. So these two projects, they are located at the near to the Robertson Quay area. Avenir is in black circle and Martin Modern in red circle. They are both near the upcoming Great World MRT, very, very near to Robertson Quay, just a short walk. See, this is a 3-line promenade. They just walk, and this is the Robertson Quay. Right now, this area is under construction for the MRT. So in future, there's a side gate here that you can walk to MRT, and there's another side gate here where you can walk to MRT. So it's very, very close. So what the factors that I mentioned about the 10 factors, I'll go through them very quickly one by one with you. Is it located, factor number 1, is it located in a good district and a good planning area with good land value? Then number 2, is there a good proportion of foreign ownership? Number 3, and so on and so forth. I will not go through them right now with you, but I will go point by point. So the first point that I'm talking about is it located in a good district with a good planning area with good land value? That means good intrinsic value of the land. Now, Singapore real estate is categorized in 3 different ways: by region, by district, by planning area. By region, we are familiar with a core central region, rest of central region, and outside central region. Districts, 28 postal districts. Planning area, 45 planning area. Planning area is very important. These are 28 districts here are postal districts, right? But planning areas are very important because that's what URA looks at. So if you use classification by region, we have the central region below the black line. You can see this black line here, right? So this below the black line is the central region. But in the central region, you also have the core central region. So the core central region, you have 3 colors here. Sentosa is considered CCR, downtown core, and the traditional core of districts 9, 10, 11, and so forth. And above the black line, it will be the OCR. Then let's look at classification by districts. There are altogether 28 districts in Singapore. Out of these 28 districts, 16 are in the central area. Okay. And if you go by planning area, we have 45 planning areas altogether. The ones that are highlighted in red are located in core central region, located in CCR. And if you look at the map of District 9, this is the shape of District 9, the green color map. And if you look at the one on the right, you see the dotted line, the dotted red line. That is the shape, the outline of District 9. But District 9 is made up of 8 planning areas. So you have a part of Kallang planning area, you have a part of Novena, you have a part of museum planning area, you have part of Rochor planning area in District 9, and of course you have the River Valley area, Robertson Key area, and so forth. So there are 8 components of that. In District 9, they are made of 8 planning areas, 8 components there. So Orchard, we have district. In Orchard planning area itself, it encompasses districts 9 and 10. Novena, you have 9, 10, 11, 12. How about Kallang? Kallang, you have 1, 7, 8, 12, 14, 15. So the portion that is in District 9 is only here, okay? So does the value here similar to value in District 14, near Geylang area? Would the value be the same? Definitely not. Likewise, this is Eddie, sorry about that. Okay, so you can see that within Kallang area, you have different values in different proportions. And then we have River Valley planning area. River Valley planning area, will the prices be the same? Let's say, for example, will the prices in River Valley same as those in Kallang? Definitely it's not. Okay, can the prices in Rochor area same as in Orchard area? Definitely not. Okay, so we have to look at planning areas and the land values. So the ones, this same chart here, you can see that the red color portions are the planning, the subzones that are located in District 9. And then you can, so I've done a summary of the DC charges payable. Now, development charge payable, I got this from URA. How do they derive the DC charges payable for a certain area? Is from the recent land sales in the area. What we understand is that it's around 2/3 thereabouts. In different areas, it may be different, but most of the areas, again, some others are maybe about we are looking at about maybe 50%. So let's say we look at the 2/3. You can see that Kallang area, DC charges payable. These are all sectors in this with sectors in District 9. Okay, the charges payable in Kallang Kampong Java area, okay, is 7,007. How about Orchard Tanglin area? Is 17,000 per square meter. $17,500 per square meter. You can see that the charge here versus the charge here, it is more than twice. So similarly, the DC charge in Momain area versus say Orange Grove area is also very different. You can see that. Okay? So this is the DC charges will reflect the land values, the land prices in the area. Okay. So number 2, is there a good proportion of foreign ownership? Why is this important? So if you were to buy in OCR, who are your neighbors? I think mostly will be Singaporeans. Yeah, maybe 95% Singaporeans. I don't know, probably around there. But if you buy in RCR, who are the buyers there? Maybe you have foreigners, some PRs, some Singaporeans. But if you were to buy in CCR, who are your neighbors? Who are the buyers in CCR? I think that most of the foreigners, if they were to invest money in Singapore, if they were to buy property in Singapore, most of them will buy a property in CCR. Okay, so if you were to buy in any particular location here, the key question to ask yourself is, do you have any advantage over your neighbors? If you have an advantage over your neighbors, it will be in the form of prices. In CCR, if the foreigners are buying, what do they have to pay? ABSD, 20%. If you are a foreigner, if you buy in CCR, you are swimming together with the rest of other foreigners who are buying there. But if you're a Singaporean, you buy in CCR, will you have an advantage over the foreigners? For sure, because their cost is 20% higher than you. But if you buy in OCR, do you have an advantage over another Singaporean? Oh, probably not. Maybe the OCR, you may have a lot of upgraders, their first home, they don't even have to pay ABSD, right? So if you were to buy In OCR, definitely you have no advantage whatsoever. But if you buy in CCR, you have locals will have an advantage over foreigners. For the foreigners, at least they will be swimming with the rest of the foreigners. They will not lose out to Singaporeans who buy in OCR. Okay, number 3, the surrounding ambience and accessibility to the project. Are there good access roads, multiple access roads? Is there any traffic congestion in that area? How about a pleasant walk to the amenities nearby? Robertson Quay is so beautiful. You just walk there, people jog, cycle, run, walk their dogs, whatever. It's so beautiful. Pleasant walk to amenities. Or do you have to cross traffic lights, cross roads with heavy traffic, under the hot sun, under the rain? So that is a very key important factor. Just like in very good areas with good access road, the land prices there would have definitely be higher. And is there good connectivity to expressways, to MRT stations? Okay, factor number 4, land size and plot coverage. This chart here is from URA. You can see that the site coverage, this is the revised control. Flats and condominiums, at least 50% must be in landscaping. Maximum concrete sitting on that plot of land. When I say concrete, meaning the structure that is more than 1 meter in height. So concrete sitting on that plot of land cannot cover more than 50%. It used to be 40%, but now it's been increased to 50%. When it's increased to 50%, it means that the condo is now more densely built compared to last time. There is less landscaping. So if you look at bungalows 50%. But if you look at good class bungalows, 40%. That means good class bungalows must have more landscaping. Likewise, if you were to buy a good class condo or a good class project, the landscaping, the site coverage must be low. For good class bungalows, the site coverage is 40%. How about good class condos? I think the ballpark figure that we can look at is probably anything between 20 to 30% site coverage. That means it will leave between 70 to 80% for landscaping. Okay, just like good class bungalows, they have a lot of site area for landscaping. Number 5, reputable developers with good track record. Over here, we have 6 projects depicted here. From launch until today, you can see some projects just one-way ticket. Okay, the prices just go down. This one went up first, and then after that couldn't hold, and then it went down. Or do you want to buy into projects where the developer's track record is good? Prices go up, prices go up. This one, prices also go up, but I want to show you that even if you go on the smaller segments, it went down, it went up, but a new high is always higher than the last high. The new low is always higher than the last low. Again, the new high is higher than the last high. So this is the kind of track record you want to look at when you purchase. When developers were to, if you were to put money in a development, if I were to put money in a development, I would want to see what's the track record of the developer. And then number 6, the number of units and unit mix in the development. Is the development full of small units? If it's full of small units and it's meant to draw renter, fine. What kind of small units are there? Is it high end? Is it mid-end, mid-segment, or is it the low end? Because different classes of projects will attract different kind of tenants. So what is the kind of tenant profile you want? Do you want the CEOs to rent your apartment? Do you want the mid-executives? Or do you want the working people or even the street ladies to rent your apartment? So this is another point that you want to consider. Okay, what is in the surrounding? What is the unit mix? How many units are there in the project? And the 7th factor I'll discuss with you is whether the project has luxurious facilities and concierge service. Nowadays, the younger people, they are very discerning. They want to have facilities. They want to have concierge. For you, you may think that, well, facilities not important to me. I don't swim. I don't use the gym. But hey, don't look at what we need. let's look at what our tenants will need. Let's look at our exit strategy. If we were to get out, if we were to sell in future, who will be our purchasers? Do we want to narrow to a small group of people who don't care about facilities, or do you want to cast your net wider to include a lot of the young people who are looking at good class luxurious facilities and concierge service? And concierge service can vary from very basic to the whole 9 years, to almost similar to butler service. So then also to consider is whether there are enough facilities to cater to the number of units in the project, and what kind of service, as I mentioned. Factor number 8, good quality finishes. High-end appliances, sanitary wares and fittings. So you have to ask your agent whether all the bedroom types come with marble in living and dining areas, or do they provide, or do they come with ceramic or homogeneous tiles. Minimally, I feel they should provide porcelain tiles. Porcelain tiles are very nice. But if ceramic or homogeneous tiles, then you know that it's a different grade already. Then of course, you attract a different crowd of people, attract different kind of buyer, okay? Then marble and timber, what kind of specifications, what kind of grade of marble, what kind of timber is it? Are the timber strips wide strips or narrow strips or small strips? The kitchen, is it imported? Do they use good material? Are they branded? How about wardrobes? Are they branded and good material as well? Appliances, do they use high-end brands such as Gaggenau, Miele, Viso, and so on? Or do they provide Electrolux or Panasonic? For high-end market, we are looking at all these good brands. Usually for the mass market, they will use Electrolux or Panasonic. So in CCR, you have different kinds of projects there. Not just Lux projects. You have various different segments. Even Lux project itself has 3 different segments. We have the ultra luxury, we have the mid luxury, and we have the affordable luxury. And we also have mass market condos within CCR. So, and then there are also the apartment grades and so on. So there are many different kinds of projects located in CCR. It depends on what you feel is suitable for you, okay? But I'm just differentiating here for you. What is the difference between a luxury project and a mass market project? And then sanitary wares, do they provide good ones like Totonio-Res or Laufen? Fittings, do they provide Exor? The Exor range is the highest range for Hans Grohe, or are they just providing Grohe? It's a different class altogether, okay? And then, of course, point number 9, rentability. Is there good rental value in the surrounding? Can the unit be rented out easily? Will it fetch a good rental yield? And what kind of facilities and amenities that the tenants will look for? And is there good demand in that particular locality? Okay, so you can see point number 10, we are now, this is the last point, architect's track record, good efficient layouts, unit sizes, room sizes, ceiling heights. So who are the architects of the project? Are they award-winning architects? Are they famous architects? Do they have 2 sets of architects perhaps? Maybe one set of design architect, or they have another set for layout architect, or a 3rd set of architects just for landscaping alone. So, and what is their track record? Have they won awards? Has the development itself won multiple awards? Who is the main con? And because of the architects, how they plan is very important. The layout, the room sizes, the unit sizes, all the units there, small shoebox sizes, the room sizes. Can the bedrooms, common rooms accommodate at least a double bed with space to walk around it, not just push against the wall or the window? How about ceiling heights? Ceiling heights, 2.85, 3 meter, 3.2. Martin Modern Avenue, 3.2. Okay, so you can see that over here, ceiling heights, I feel that minimally for a good class project, minimally 2.85, preferably at least 3 meters and above in terms of ceiling height. So if you look at Martin Modern, the 10 factors that we talked about, all the factors here, Martin Modern satisfies every single aspect from points 1 to point number 10. And then if you look at the Avenir, similarly, they meet all the 10 points, the 10 factors that we can consider. Remember what I said just now, if the project under consideration is, you can meet 10 points, that's fantastic already. I did not use a good one versus a bad one. I don't want to put any project in the spotlight. I just use 2 good projects here for you to see that all these characteristics are not just abstract. All these factors are not just abstract, but whether the project can really meet this kind of factors to consider. Okay, so you can see over here that we have the unique selling points of the projects, combination of the best aspects of the recent CCR projects, 3.2 meter ceiling height, full condo facilities, large land plot, 75 to 80% land dedicated to landscaping. That means the site coverage is only 20 to 25%. Designer provisions, low density, not overcrowded, efficient layouts, concierge service, and of course I mentioned about the ceiling height. So these are various points to consider. And so will the project outperform in the long run, especially now whenever we face a crisis in the market? Can the project hold water? Can the project hold the value, retain the value? And not just retain the value, when the market runs, can that project run faster than other projects in the market? Luxury projects located in CCR have many attributes that mass market projects don't. Therefore, the premium that one pays for it, but it's worth it. The slight premium will hold you in good state. Discerning buyers in this class, okay, they will be able to see the value and the difference. Will the project age graciously? Will the design stand the test of time? What is the intrinsic value of the land? That is one of the most important to hold the value of the land. According to the first factor that I spoke to you about just now, will prices of the development hold out well in times of crisis? So to seek out performance in the long term, one needs to look closely to study the factors that will affect future pricing. So with that, I thank you very much for your attention, for your time. If there's any questions, do post in the Q&A. Thank you very much. Eddie, would you like to take over? Hi, Eddie.
Hello, Stella. Thank you for your insightful sharing. I think Eddie is currently on the line, perhaps. So we will just assist to take some questions from the ground. So
Okay.
There's somebody who actually asked one more questions from the ground about limiting the size of the property in the OCR, right? For future launches, will it be bigger and newer? And does it mean or translate that to the new current launches in the OCR will be difficult to sell in future in the resale market?
Sorry, the question was very long. Can you repeat the last part again?
Okay, just to maybe summarize the question, right? Is it based on restriction of the size of the property, right? Will it affect the current launches, right, to be difficult to sell in the future?
I don't think so, because it all also depends on which sector of the market you are referring to. Because for good class projects, the average sizes are usually bigger anyway. The minimal size is to curb the overbuilding number of projects in especially the mass market segment. So for mass market segment, you want to choose. You can always consult the agents, but definitely because of the fact that the minimum size is now bigger, they have increased the minimum size, which means that developers cannot build so many, and therefore the new ones going forward, developers have to build bigger ones, and because of that, they cannot overbid for the land.
Right, and also you have shared why the developer have actually so-called restricted in terms of the take-up rate recently due to the measures, right?
Yes, that's right.
Yes, appreciate that. Thank you. And also you have shown a lot of infographics, which is much appreciated by all the audience. We have overwhelming of thank you for your insightful sharing. Then we have another question, right? Based on, give me 1 second, because there's some questions flooding in. Okay, so there's one more that's, okay, one of them is giving you some good testimonial, which is like saying you speak like an economist, like an experienced economist in a property sector analysis. So actually,
to help my husband's research as well. Thank you.
Thank you very much. Thank you very much. And then I think that the other one is, what do you think of one per bank? I mean, this one is a more like a reference of some other projects which you didn't specifically mention, because we are not here to share a specific development, right? But generally how the market is performing, etc. So I think there's one that is asking for some comparison between one per bank, Warwick Residence, and Marina One for investment, between the 2 to 3 bedders. Your personal view on this 3 comparison?
Okay, I have not studied one per bank in detail yet. However, one per bank is popular, I think, because of the views as well, and it is located in a relatively good area as well. For Warwick, I simply love Warwick. Warwick is ultra luxury, and Warwick is has a similar class to, say, Boulevard 88 or to South Beach. Okay, so it's a very different class. It caters to ultra luxury. Then of course the Warwick, the 1 2 bedrooms, 1 bedrooms, 2 bedrooms gone already. We have 3 bedrooms. Even the 4 bedrooms are being stepped out recently by a lot of foreigners. So we have a good value 3 bedrooms to sell. For Marina One, the pricing is so good. Marina One has very, very attractive pricing. Even though it's in CCR in the heart of Marina Bay, the prices starting from 2,170 per square foot is really a steal. It's really, really good pricing.
All right, thank you so much for sharing, Stella. I think one last question for you, right? One last question is actually, what is your view on the expected capital gains, right? Given the established and the stabilizing prices over the years?
Expected capital gains. Okay, let's be more realistic. You know, even though Morgan Stanley came out with a report, this report was done at the end of 2016, captured by Business Times in April of 2017. In that report, Morgan Stanley said that from 2016, when they did the end of 2016, when they did the report, for the next 14 years, all the way to 2030, in a 14-year period, they are expecting prices to be around 5% per year. Anything more than 7%, they have shown that the government came in to implement all the cooling measures. Anything below 3%, the government actually eased off the measures. But I think that moving forward, because now we have a higher base, moving forward, I think that if we can achieve 3% per year, you go and compound it. It's really fantastic. If based on 5% as per Morgan Stanley's report, if you go on 5% per year, you key in 14-year period. Within 14 years, your property price would have doubled.
All right, thank you so much, Stella. Yeah, so there's one last question which I also find is one of the very frequently asked questions. And I think it's good that you touch on this point as well, because for the benefit of all the audience out there, right? There's actually a question regards to the new launch condo, right? Versus the resale, which is slightly less than 10 years old, which is relatively new. Based on this kind of situation, right? The price, if there's a gap, which one do you think is a better deal in terms of your personal opinion?
Okay. You know, recently my 2 daughters bought properties as well. And we all studied, okay, resale versus new launch. And definitely new launch tends to reward people better, because developers actually, especially when you buy during the first year, developers price it very attractively. And so the more they sell, the more they will increase the price. Okay, so when they keep increasing the price, you can ride along with the price. So with that, you will be able to hitch on the ride up and get more capital gains if you are an investor. So I think for me personally, okay, that's my own personal opinion, but you can always consult with your PropNex agent who invited you to work out, because everybody's situation may be different, whether a new launch will work out better for you or a resale unit will work out better for you.
All right, thank you very much, Stella, for all your insightful sharing. And we have over 1,000 guests for tonight, and really appreciate all for tuning in. And for those of you who have still some questions, right, that you may want to ask Stella, or perhaps work together with your agents, you can kindly get back to your agents and let them have a better and more in-depth research for you in terms of tailor-made strategies. Okay, and we really appreciate your time for tonight. Thank you, Stella, for your sharing, and thank you, everyone. Have a good night.
Thank you very much. Thank you, everyone, for your time today. Bye-bye.
Thanks. Bye-bye.
Bye.